The market just delivered its fourth consecutive weekly gain while simultaneously driving gold and silver to all-time highs. If that sounds contradictory to you, it should, because what we're witnessing in these final days of 2025 isn't strength, it's fragmentation. And fragmentation, my friends, is exploitable. I'm going to show you exactly why this market behavior reveals a psychological breaking point, how the system is responding with surgical precision to conflicting signals, and most importantly, the disciplined approach that capitalizes on this chaos, while others get whipsawed by their emotions. Here's what's actually happening beneath the surface noise. The S&P 500 closed at 6,929, up 17.8% for the year, hitting fresh all-time highs just days ago. Sounds bullish, right? Meanwhile, gold notched its 54th record close of 2025. Silver rallied 155% for the year, hitting $76 per ounce. Bitcoin ETFs hemorrhaged $175 million in outflows, while the index celebrated new peaks. This is not a market with conviction. This is a market hedging all outcomes because it cannot decide which narrative to believe. The human layer here is textbook late-cycle psychology. We have participants who rode an 18% rally, now facing cognitive dissonance. They want to believe the rally continues, but they're simultaneously buying insurance against its failure. The GDP print at 4.3%, crushing consensus by over 100 basis points, created the classic paradox where good news became bad news. Strong growth means fewer rate cuts. Fewer rate cuts mean higher discount rates. Higher discount rates mean compressed valuations. But here's where it gets interesting. The crowd responded with rotation, not capitulation. Money flowed from mega-cap tech into financials, from growth to value, from paper assets to hard assets. This isn't panic, it's hedging, and hedging reveals uncertainty masquerading as sophistication. The precious metals surge tells the real story. When silver gains 155% in a year, while the economy grows at 4.3%, you're not seeing fundamental revaluation. You're seeing monetary debasement fears. The market is simultaneously celebrating economic strength and betting against the currency that measures it. The contradiction is almost amusing. Now let's examine how the system processed these conflicting inputs. The bond market responded with surgical precision. The 10-year Treasury tested 4.19% before settling at 4.13%. The 2-year yield dropped to 3.48%. This flattening spread tells you everything. The market pushed out rate cut expectations while maintaining faith in eventual easing. Translation: the Fed has more time to wait. Equity indices absorb this information asymmetrically. The Nasdaq's 22% year-to-date gain versus the Dow's 14.5% reflects AI capital expenditure dominance, but even Tesla and Nvidia retreated in pre-market trading. When the momentum leaders show weakness, that's not a rotation, that's exhaustion. The Russell 2000 declined 0.54%, while large caps held steady. Risk appetite isn't expanding, it's concentrating. Capital is flowing to fewer, higher quality names because participants sense the easy gains are behind them. When the market must work harder to find returns, spreading capital across more names rather than compounding it in fewer winners, this indicates diminishing marginal returns to the prevailing strategy. Commodities exhibited perfect bifurcation. Precious metals surged while crude oil fell 2.8%. This divergence reveals a market pricing monetary fears rather than growth optimism. Copper breached $12,000 per ton on supply concerns, but oil declined on demand fears. The system is pricing conflicting economic scenarios simultaneously. The crypto market tells perhaps the most honest story. Bitcoin remains range-bound between $86,500 and $90,000. 3 failed attempts to break higher, consistent selling pressure at psychological levels. The $555 million in combined Bitcoin and Ethereum ETF outflows signals that institutional demand has paused. Without new capital entering, price becomes a function of existing holders' willingness to maintain positions. That's inherently unstable. Here's what the Stoic approach reveals about this environment. We're observing a market that requires threading a needle between contradictory outcomes. If growth remains robust, the Fed won't ease aggressively, removing the liquidity tailwind that justified current valuations. If growth decelerates, earnings estimates compress. The market is priced for a Goldilocks scenario with an extremely narrow path. Such paths rarely persist. The holiday-thinned liquidity creates additional complexity. Price discovery is impaired when only a subset of participants are active. Moves in this regime carry less information content because they reflect non-representative samples. The Santa Claus rally narrative provides cognitive comfort, but historical patterns lose predictive power when underlying conditions change. The technical structure shows compression across asset classes. The S&P 500 trading just 1% below 7,000, while volume remains below 30-day averages, creates a coiled spring dynamic. The VIX at 13.60 reflects complacency, yet precious metals surge contradicts this sanguine volatility pricing. This disconnect between implied volatility in equities and realized volatility in commodities represents structural tension that must resolve. The system is exhibiting classic late-cycle signatures: valuation expansion without corresponding earnings acceleration, rotation from momentum to value, defensive positioning in alternatives, compressed volatility despite elevated uncertainty. These conditions don't predict timing, but they define risk-reward asymmetry clearly. The cost of being wrong now exceeds the benefit of being right. So what's the disciplined response? First, recognize that extended markets operating in liquidity vacuums favor range-bound trading with sharp reversals. The path of least resistance is sideways until a catalyst forces resolution. We don't predict which direction that resolution takes. We position for either outcome. Second, understand that when everyone is hedging, the edge belongs to those who can wait without acting. Capital preservation becomes the primary objective. Patience becomes the primary tool. The market rewards those who can maintain flexibility, while others chase momentum or fight trends. Third, focus on asymmetric opportunities where potential gains exceed potential losses by meaningful margins. In fragmented markets, the highest probability trades often involve betting against extremes rather than chasing them. Silver's 155% gain creates more downside risk than upside potential. Bitcoin's failure at $90,000 after 3 attempts suggests overhead supply, not accumulation. The week ahead brings FOMC minutes on December 31st. If they reveal dissent about inflation persistence, markets reprice hawkishly. If they show consensus around data-dependent pauses, markets interpret this as dovish. We observe these inputs without attachment, knowing each data point is a single frame in a longer film. The geopolitical backdrop with China's Taiwan exercises and stalled Ukraine talks adds tail risk not priced into current volatility levels. Markets have become desensitized to geopolitical headlines, creating vulnerability to actual escalation. We maintain awareness without overweighting low-probability, high-impact events that are difficult to hedge efficiently. The final assessment: this market is extended, fragmented, and operating in a liquidity vacuum. These conditions create opportunity for those disciplined enough to wait for proper setups, rather than forcing trades into unsuitable environments. The crowd reacts emotionally to each headline, each data point, each narrative shift. We remain disciplined, focused on process, accepting of outcomes we cannot control, while exploiting the patterns that human nature makes inevitable. If you value systematic thinking over emotional noise, if you prefer objective analysis to market cheerleading, then subscribe and join those who understand that markets are exploitable precisely because human behavior is predictably irrational. The link in the description contains the complete framework, the full system for identifying and exploiting these psychological patterns across all market conditions. Because while others chase momentum or fight trends, we profit from the eternal constants of human nature.